We're about a minute to the closing bell. James Knightley, ING Chief International Economist, is going to help us get there, as is Michael Antonelli, Baird PWM Market Strategist. Good to have you both here. Want to take a quick look at where we are headed as we go toward the closing bell. The Dow accelerating to the downside, off about 214 points. Going to come back to that in a second. S&P 500 off about 9 points. The NASDAQ, however, NASDAQ is trading higher, up about 25 points. When we talk about the Dow, there are some winners today. Apple is up a little bit over almost 1.5%. There's the news of a potential upgrade for Apple's iPhone 14. We're still buying the iPhone 12. Okay, but Apple's getting a boost off of that. Salesforce up today, just under 1%. So is American Express. Some of the losers today on the Dow include Dow Inc. as well as Caterpillar. Caterpillar's off about 2%. Walt Disney is off almost 2%. And then as we were talking earlier, well, there's the closing bell.
And that does it for the trading day today. As we shake out the final trades of the session, Dow and S&P are going to end in the red. We have the Dow, looks like it's going to close off just over 200 points. And you can see on your screen a loss of 204. S&P off just around 0.2%. The NASDAQ holding on to the gains. A lot of that has to do with the outperformance that we've been talking about over the past hour with some of those big tech names, those big cap tech names. So certainly that's helping to boost the NASDAQ today. But again, the Dow closing off just over 200 points. We want to bring in James Knightley and Michael Antonelli to help us make sense not only of today's action, but what we're likely to see going forward from here. And Michael, let me start with you because stocks today, yes, they're under pressure, but we're still not too far from those all-time highs that we hit last week. I guess, what do you think the second half of the year is going to look like?
Yeah, I don't want to take the blame for this, but we just ended a 7-day winning streak for the S&P 500. So we were close to like the all-time record, but we just kind of ended it there. The second half, honestly, it's shaping up to be just kind of a continuation of what we've been seeing, but maybe a little moderation in these growth rates. If you looked at earnings expectations for this quarter that are coming up, they're up about 60% year over year. So earnings expectations have been absolutely soaring. In fact, if that's what it ends up being, that'll be back to pre-pandemic levels. So that rate will probably come down, but we can't be disappointed with that level of growth expectations and earnings. Forward PEs still pretty high, above 21. But I think, honestly, the second half is shaping up to be a continued reopening, continued expectations for better earnings, and a possible correction. I do think that we'll probably have a correction of some kind in the second half.
James, I wanted to point out something you told your clients to be focused on, and that's the fact that 46% of small business owners had job openings they could not fill. I understand how the big companies can continue to go forward, but when you have that kind of labor shortage, how do you continue to keep earnings growing strong? I realize the last year is an anomaly, but going forward, 20% earnings per share growth, how do we get there if there's a labor shortage?
Yeah, I mean, we've got to remember that half of all jobs in America are in the small business sector. So it is a critical part of the economy. So if they can't get workers, and as you say, we're up at record levels or record proportion of companies that cannot fill their vacancies, well, that's already leading to rising compensation. We saw that in the National Federation for Independent Businesses. They're reporting the highest rates of increasing worker compensation on record. And even in today's data, the Institute for Supply Management reported again, a contraction in employment. Now, this isn't because there's no demand for workers. There's clearly huge demand for workers. There's just no supply. And, I'm just a little bit anxious that there's this expectation that we're going to get this wall of workers returning in September, to resolve, once schools are back, the childcare issues are resolved, the extended unemployment benefits cease, and therefore everyone's going to be back. Well, I think there's growing evidence that we've got, a lot of people have taken early retirements. The 401k plans with the booming equity markets, it's triggered this big big wave of retirement. So I'm just a little bit anxious that, we're going to be quite tight in terms of the jobs market. That's going to put up costs in terms of worker compensation. You've already got supply chain bottlenecks coming through, and that's adding to the difficulties for not just small businesses, but large businesses as well. And this creates an environment where you've got very strong demand, coming up against these bottlenecks. For me, we've got the best environment for corporate pricing power that we've had for potentially 20, 30 years. So I'm just a little bit nervous that this is all building up to perhaps a little bit more inflation than we've been anticipating, and certainly more so than the Fed have been anticipating.
Michael, you mentioned a possible correction before. I guess how big of a pullback do you think we could see, and how should investors play that drop?
So here's how I think about equity market corrections and pullbacks. Here's how I kind of think about equity market risk, if you will. What are the odds of something happening times how bad it will be? Right? If you think about COVID, what was the odds of it happening? Low. How bad was it? Well, we know how bad it was. Every single year, if you were to take any single year in history, you should expect about 3 5% corrections and 1 10% correction. That's probable. That's what history tells us. That's kind of evidence-based investing. We've had 1 4% pullback. So to me, the probability of another pullback, whether it's 5 or 10%, is high, right? We've only had 1. On average, you have 3. Even if you looked at 2017, which is 2017 is one of these benchmark great years where the market just basically went straight up. There was a correction, albeit 2 to 3% in August of that year, kind of as we were coming out of summer. So when I say I think we'll have a correction, it's probable. And that's honestly how you should think about the market. That's obviously impossible to predict. What's the probability of something happening? It would be probable that we'll have a correction. How should they play it? Like they always play it, which is kind of the steady drip of their investments, their kind of month-end investments, and then looking at these things that are breaking out. The FANG names are basically all at new all-time highs after kind of long corrections. These names will probably be attractive going into the fall.
Michael, I'm going to quote Han Solo, don't tell me or never tell me the odds. We got to get to Jared Blickery, though, because he watches the odds. He watches a lot of things down at Knightley.
All right, well, let's take a look at the NASDAQ and just kind of building on Michael's comments about potential corrections here. Now, this is the NASDAQ going back 3 months. From the June time period, we saw mega caps really accelerate. We also saw breadth in the NASDAQ 100 and the composite indices that deteriorated. So you don't have as many stocks contributing to those record highs. You just kind of have the big ones right now. But we've seen this before. You take a look at what happened since 1 year ago, even going back just before that time period to the March lows. We saw mega caps kind of lift the entire market. That we do need some other sectors to kind of come along every other day or so, but this does create a fragile market situation where we have the potential for a correction just because we don't have a lot of news for the next few weeks. It is summer trading, lots of people on holiday, so we could see some sharp pullbacks, but they've been very, very shallow in the NASDAQ and even in the Dow where we've seen some more substantial ones, really not that much to write home about anyway.
James, let's take a look at the bond market. And Jared mentioned it earlier today. The 10-year and the 30-year yields today ending at the lowest level that we have seen since February. I guess help us make sense of what's going on in the bond market. And this move lower, does it make sense to you?
Well, it is difficult to reconcile when you've got an economy with inflation at 5%, with the highest rate of core inflation for 30 years, and an economy that's likely to grow 6% this year. It is a little bit tricky to match that up. But, you think that the 10-year yield rate's looking over the next 10 years. And while I think everyone is very upbeat about the prospects for this year, there is perhaps some doubt as to the longer-term position of the U.S. economy. We were talking about potentially a $3 trillion investment program from Joe Biden at the beginning of the year. Well, that got cut to 2.2 trillion. It's now down to 1.7 trillion. It could be below 600 billion. So those sorts of impulses that we were thinking about as being a big growth driver over the medium term, they may not be as supportive as possible as we would have liked. There are other issues as well. I mean, you look at the story in Europe as well. You've still got a German Bund, which is yielding minus 30 basis points. So, positive 1.4% still looks pretty attractive for a global fund manager perspective. So, you can sort of pick out various bits and pieces. But overall, I still think that we should be looking for the US 10-year yield to be pushing higher through this rest of this year. I think, as I mentioned earlier, the inflation backdrop could be a little bit more persistent. And I think we could be seeing the Fed come in with slightly earlier interest rate hikes as well, perhaps more aggressive rate hikes too. So I still think we'll be seeing the 10-year yield ending the year quite a bit higher than we are today.
Well, Michael, what do you think of that? Because look, if there is going to be a pullback and there are investors parking cash, getting ready to buy on a dip, this doesn't make sense right now to see the 10-year below 1.4%.
Yeah, James makes a lot of great points. He really does. I'm an equity guy at heart. I kind of lean on the fixed income crowd for the takes. But here's what I think. here's what I know, I guess. Price pays, okay? Price pays. The price is what it is. What's going on with the 10-year? It might be thinking a little bit lower growth. It might be a return to sort of this kind of 2 to 3% trend growth the U.S. has been in for the past decade, and that's why these kind of FANG names are back. It could be this kind of flows over pros kind of thing, where there's just such an endless flow into the Treasury market that it's just constantly being bought, regardless of price. So there's lots of things, demographics, potentially kind of slower growth expectations. If you look at the Atlanta Fed, that number's been coming down for the second quarter. It's down to about 7% from a starting around the 11% area. So I'm just as confused. Obviously, the inflation trade is either peaked or the market's completely wrong. It's just one of those two things. Either the worries have peaked or the market's just mispricing it, because you can't possibly say that with a 10-year in the 130s that inflation is still a big worry. That doesn't make sense to me.
Only time will tell, I guess, which side the argument is right. Jared, we want to get back to you real quick from the floor of the NYSE, because we had the Dow off 200 points today. The NASDAQ, however, closing at a record. The craziness that we've been talking about, the action that we've been seeing in yields. I guess, what's your big takeaway from today's action?
Well, despite all the craziness, I'm really not seeing that reflected in one of our crazy asset classes. That would be meme stocks. I just want to show the Wi-Fi Interactive real quickly. Looks like AMC is down 3 or 4%, even though they said they're not going to be diluting their shareholders to the tune of another 25 million shares. But Newegg Commerce, this was a GameStop Reddit phenomenon. Ticker that we saw really rise in late January, early February. That is up 41% today, so that's something we'll be watching tomorrow. And then also Bitcoin didn't have much of an eventful, I would say, weekend, and that could be good or bad. But I'll tell you what, the more it consolidates around these recent lows, the greater the chance for another leg lower. So we'll be on the lookout for that over the next few days as well.
Jared, thank you. We also want to thank Michael Antonelli. He's Baird's Private Wealth Management Market Strategist, and also James Knightley, ING Chief International Economist. We look forward to having both of you join us again here on Yahoo Finance Live.